Are we on the brink of another financial crisis? That's the question on everyone's mind as we witness emergency meetings, fluctuating bank shares, and central banks offering credit lifelines. Welcome to our channel, where we delve into the latest economic trends and provide insights to help you navigate the complexities of the financial world. Today, we're exploring the topic of banking crises and their potential impact. So, strap in as we uncover the truth and answer the burning question. Is this a banking crisis? And how worried should you be? If you find this information valuable, don't forget to subscribe to our channel to stay up to date with our latest videos. Now, let's dive in. What's happening with banks, and are they collapsing? First, let's address the current state of banks and the possibility of collapse. In the United States, we've witnessed the closure and sale of 3 mid-sized banks since the beginning of March. These failures are the most significant ones since the 2008 financial crisis. Additionally, in Europe, the troubled Swiss giant Credit Suisse is being taken over by rival UBS in a forced rescue deal. These collapses were triggered by customers' concerns about the safety of their funds, leading to mass withdrawals. However, central banks have stepped in to mitigate the crisis by making extra cash available and ensuring that financial transactions continue as normal. Central banks rush to keep cash flowing. When faced with a banking crisis, central banks take swift action to maintain liquidity and boost confidence. This strategy was implemented during the 2008 financial crisis and at the onset of the pandemic. Its purpose is to enable banks to continue providing loans and meeting customer demands for withdrawals. As the situation stabilizes, some of these emergency measures are gradually being phased out. Are UK banks at risk? With all the recent turbulence, you might be wondering about the safety of UK banks. While bank shares have experienced fluctuations and confidence has been shaken, there is currently no reason to anticipate any direct impact on UK banks resulting from the collapse of Credit Suisse or the smaller US lenders. In fact, the UK banking system remains safe, sound, and well capitalized. The Treasury spokesperson emphasized this, stating that the collapse of these banks is a matter for the US authorities. Why is this happening now? Let's explore the underlying causes of the current banking crisis. The turmoil we're witnessing is, in part, a consequence of central banks raising interest rates significantly last year to counter rising prices. After years of historically low interest rates, this sudden shift caught many banks off guard. The value of their assets, especially those acquired when interest rates were lower, plummeted. As customers panicked and withdrew their money, some banks found themselves unable to weather the storm. The sequence of events began with Silicon Valley Bank, catering to the tech industry, revealing its need to raise money. This revelation sparked fears, subsequently leading to the downfall of Signature Bank and, ultimately, First Republic. Credit Suisse. Lessons learned from the past. Credit Suisse, a troubled Swiss banking giant, faced its own unique set of problems. It had a history of risk management missteps spanning several years, and it was embroiled in scandals involving money laundering. Last year, it reported heavy losses. In March, the bank experienced a sudden downward spiral as worried customers transferred their funds elsewhere, despite receiving a $50 billion emergency lifeline from the Swiss National Bank. Is my money safe? Many individuals are concerned about the safety of their hard-earned money amidst the current banking crisis. Rest assured, ordinary people have little reason to fear for their funds. In the highly unlikely event of a bank collapse, deposit protection is in place. In the UK, the Financial Services Compensation Scheme protects up to $5,000 per person per institution, or $770,000 in a joint account. Similarly, the EU and the US government have their own deposit protection mechanisms. The US government, for example, has long safeguarded deposits of up to $250,000. Moreover, discussions are underway to potentially increase protection for business accounts in the aftermath of the crisis. Is this a banking crisis like 2008? Finally, let's address the elephant in the room. Is this a banking crisis on par with the catastrophic events of 2008? The consensus among most experts is that the current troubles do not indicate a system-wide problem similar to the one we faced in 2008. Significant measures have been implemented since then to strengthen banks. including increased capital requirements and tighter risk regulations. Nevertheless, the world of banking remains complex and interconnected. Identifying new vulnerabilities can be challenging until the system experiences pressure, as it did during recent economic strategies and interest rate adjustments. Although we may not witness a complete breakdown of trust like in 2008, regulators might tighten rules further, and banks may become more cautious about lending. These factors could potentially impact the global economy, adding an unnecessary chill during a time when it can least afford it.
So how big is this crisis then?
In spite of the shockwaves, there are reasons to believe that the banking crisis could ultimately have positive effects on global markets, stated Nigel Green from the DeVere Group in a note on Monday morning. Green emphasizes that the interventions and support provided by regulators and governments have acted as emergency measures to prevent the risk of contagion within the banking sector. As a result, the potential for turmoil to spread to other firms and sectors has been contained. The series of events began with the collapse of Silvergate's SVB and Signature Bank in the United States. Silvergate, a bank friendly towards cryptocurrencies, announced its intention to liquidate. Subsequently, SVB faced regulatory intervention on March 10 and was placed under the control of the Federal Deposit Insurance Corporation. FDIC later took control of Signature Bank as well. The situation unfolded rapidly, particularly in the case of SVB, which is the country's 16th largest bank. Once SVB announced its need to raise capital, customers panicked and hastily withdrew their funds. This swift withdrawal of funds from SVB highlights how rapidly a bank run can occur in the digital age. In response to the concerns arising from the banking crisis, the Treasury, the Federal Reserve, and the U.S. President swiftly took action to reassure depositors about the safety of their money. However, another crisis was unfolding in Europe. Investors had been closely monitoring the gradual decline of Credit Suisse over the years, primarily due to accounting errors, involvement in multiple scandals, substantial losses, and numerous attempts at turnaround plan. The collapse of SVB exacerbated these concerns as investors started looking at other banks that could potentially be in a similar vulnerable position. The recent focus on banks, though primarily for negative reasons, has also highlighted to investors that the regulations implemented following the 2008 financial crisis have positioned most banks to withstand shocks, commented DeVere's Green. Nevertheless, banks worldwide are still adapting to the sharp rise in interest rates. For years, lenders had become accustomed to borrowing at low costs due to the long period of ultra-low interest rates maintained by central banks globally. However, the sudden increase in rates over the past year has left borrowers struggling to manage their portfolios. What's next? Investors are closely monitoring two significant developments in the market to gauge the unfolding of the banking crisis. Credit Suisse announced that, as part of the rescue plan, the Swiss regulator is demanding a write-down of nearly $17 billion on the lender's additional Tier 1. This news has unsettled investors and triggered a sell-off in other bank debt, which has consequently weighed down share prices. Russ Mould, the investment director at AJ Mould, highlighted this concern in a research note on Monday morning, stating that it signifies a new chapter in the ongoing banking crisis rather than its resolution. AT1, or contingent convertible, CEO, bonds are essentially debt securities that convert into equity when a bank's capital buffers dip below a certain threshold. In the aftermath of the 2008 financial crisis, the Bank of International Settlements, BIS, made it mandatory for all European banks to issue COCOPO bonds. The second significant event to watch this week is the Federal Reserve's decision on interest rates, scheduled for Wednesday. Initially, most economists and market observers anticipated a 25 basis point rate hike, which would push the U.S. central bank's benchmark rate to 5%. However, the coordinated action taken by the Fed and 5 other central banks on Sunday night is being seen as a move towards pausing rate hikes. The market has experienced volatility in recent weeks, and while central banks, regulators, and governments have stepped in to contain the spread of instability, there remains substantial uncertainty about how the global economy will be affected by the environment of high inflation and high interest rates. Central banks are aware that in addition to combating persistently high inflation, They also need to ensure financial stability. The events of the past week, which shook confidence, will certainly give them reason to pause, commented De Beers Green. The increasing argument for a pause in interest rate hikes will be met with relief by global markets. Conclusion. So, how worried should you be about the current banking crisis? While the situation has raised concerns and caused fluctuations in bank shares, it's important to note that significant efforts are being made to stabilize the system. The lessons learned from past crises have led to stronger regulations and improved capitalization of banks. Although uncertainties persist, your money remains protected and the likelihood of a widespread collapse appears low. As always, it's crucial to stay informed, monitor the situation, and make sound financial decisions. If you found this video insightful, don't forget to subscribe to our channel for more informative content. Until next time, stay vigilant and take care.